It began in the US last Friday, engulfed Asia today, and is heading back to the US now. Dow, Nasdaq and S&P futures promise another day of big losses for the American stock markets. Once the darlings of Wall Street, now leading the losers. Apple, Nvidia, Meta and Microsoft are set to open with big losses. Car maker Tesla's futures point to a poor open in trade. SEBI issues rules to check front-running in mutual funds and other fraudulent practices, makes fund managements accountable. Indian markets end lower amid a global sell-off as the benchmarks close nearly 3% lower. 12 sectors end in the red. Nifty metal emerges as the worst performing sector. What should you do in a volatile market? How should you trade? We bring you expert opinions ahead on the show. Bangladesh Prime Minister Sheikh Hasina resigns and flees the country amid violent protests. She may be headed to a safer location in India. The Bangladeshi army had reportedly given a 45-minute ultimatum to the Prime Minister to step down. And Gautam Adani lays out his succession plan in an interview with Bloomberg, says he plans to retire at 70. The future of Adani Group lies in the hands of his sons Karan and Jeet Adani, along with nephews Pranav and Sagar Adani. Good evening and welcome. This is Profit 360 and I'm Nupur, Talwar, Suri. Muralidhar Swaminathan is also joining me in the studio. Right, so all eyes are on the US markets after Friday's tumble in the US markets. Asia followed suit this morning. Fears of a recession in the US economy were rekindled after unemployment data in the US grew higher than expected. It is likely to be another rough day for the US markets if the futures are to be believed. Dow Jones Industrial Average futures lost about 800 points. The Nasdaq 100 futures are also down by about 5%, while the S&P 500 futures are down 3%. And in fact, Matt Orton, head of advisory solutions and market strategy and chief market strategist at Raymond James Investment Management, joins in from Florida. Hi. Your initial thoughts? It's not looking very good, is it?
No, it's never fun to wake up on a Monday morning and see the extension of the sell-off.
Right, absolutely. So what is your expectation from the day today? The Nasdaq 100 futures already indicating perhaps what could be the index's worst open in 4 years. Now, also break down for us what is leading up to this. Of course, the jobs data was very, very poor. Apart from that, Japan didn't do too well as well. So is that a tailspin effect that we're seeing from the Asian markets?
So I think when you take a step back from all of this, it's important to put the totality, to steal a word from Jerome Powell, the totality of all of the data and all of the different moves into context. Because I think what really started a lot of the jitteriness in the market really goes back a month ago to the big rotation that we had in the US, moving out of mega caps into small caps, into more cyclical names. I mean, literally just a month ago, we were all enthusiastic that the growth story was intact, that the economy was going to have a soft landing. And now we received some data points that I think has thrown that narrative into question. At the same time, you're seeing the unwind of a $10 trillion plus carry trade with the yen, and the BOJ further spooked markets last week by increasing rates by 25 basis points. So I think a lot of investors have been caught off sides on multiple fronts of different trades. And you combine that with thin summer liquidity, it just is a recipe for really, really big moves in the market. So when you see the NASDAQ down 4% or so, it's incredibly uncommon. It never feels good, but I think it's important for longer term investors to sit back and ask what fundamentally has really changed to justify these moves. I would say there hasn't been that much from a fundamental perspective that has changed my opinion with respect to a soft landing in the US. And so I'm looking for a little bit more calm to come back to the markets. And that's when I want to start using this opportunistically. We haven't had a chance to put money to work in a long time. So for all of those investors who've been sitting on the sidelines saying, I need a better entry point to put money to work, this is it. So I'm telling investors they should really be getting their shopping list ready because we will have a good opportunity to put money to work over the long term.
Good morning, Matt. Murli here. We can keep the shopping list ready, but before that, I just want to, before I ask you a question, I think the US markets have opened, the cuts are very sharp. You can see them on the screen. Amazon is down about almost 10%. Apple is down 10%, almost, I think, the worst fall in 4 years. And you can see on your screen multiple indices, stocks, whether it is Alphabet or Tesla, name it, they are all sharply down. My question is, it started in US, went to Asia, and then went to Europe. Now it's back in US. Is this a contagion?
I don't think it is. I think, at least in the short term, there's been a lot of technical damage done to charts, and we're in that cycle where I think you have some algos that are driving a lot of the trading activity, taking off of these cues. But there will come fundamental levels where investors and real money is going to come back into the market and say, some of these stocks, the mega caps being down 10+%, in a single day after already being down 10+% 1 or 2 days in the last week, the forward multiples start to look really, really attractive. And again, I think there's a lot of money that's just been sitting and waiting. So I think a floor is going to come, but until the algos until the algos are put back into control and you have real money starting to guide the markets, I think you're going to see this whipsaw effect start to take effect. What I'm looking for most is, do we violate the 200-day moving averages on some key charts? Is that going to be a harbinger of some further downside before money starts to come back in? But I don't think this is going to be a contagion where you continue to see sell-off after sell-off in global markets, because money is going to come back to work.
Okay, so you seem to be very optimistic and hopeful that money will come back to work and it is not a contagion. Hopefully it is not. But what will it take for the markets to calm and come back? Do you think a good word from Fed or somebody, one of the Fed governors has also pointed out that, Fed will do whatever it takes and the usual routine line. So what will it take for this, relentless selling to calm down and investors to calm down?
So I think any sort of good economic data is going to be helpful. Unfortunately, we don't really have too much of note until you get to August 14th, where you've got the CPI in the US. I think that's going to be really important. But we do have some points this week that are going to be worth following. You have ISM services. I think following the employment component of that is going to be important. We're going to have the senior Fed loan officer surveys later this week on Thursday. I think not seeing credit deterioration, willingness of banks to lend money, I think all of that might give a little bit more confidence to people that things aren't really that bad, or at least as bad as the market is signaling them to be. And I think if you get those little confidence steps, that will give some people the willingness to start to step in and start to put money to work in this market.
Right. There are some very, very smart investors who have moved to cash. There were reports suggesting that Berkshire, Warren Buffett had moved to almost $290 billion in cash. What's your assessment? Are many people sitting on cash, and what we are seeing now is simply a speculative position cut that is bringing the fall?
That's a really good point, because a lot of investors have been overweight cash. I've been telling a lot of our investors, at least over the past couple of months, that they should be using the current levels of interest rates to lock in income going forward. And that's been the right call, especially given the massive backup we've seen in Treasury yields over the past few weeks. And I still think there's opportunities for investors to do so, because we know a cut's going to be coming. The question is just how big is that cut going to be? So remaining in cash is not the trade. Whenever you start a rate cutting cycle, cash unambiguously underperforms in every single case. So I think investors who are moving there are doing it more from a positioning standpoint. They're taking profit on some trades and looking for other opportunities, which isn't a bad idea in this sort of market. But I think a lot of that cash, to my point earlier, is going to need to find a home. And when you see some stocks that are down 10%, that have rock solid balance sheets, have just posted good earnings, that's a good opportunity to start to maybe redeploy that money and put it to work, especially if you do get a little bit of encouragement from the economic data.
Quick question on the geopolitical side of it. Are we seeing an impact of the tensions between Iran and Israel, perhaps, and what's your sense of that?
I think that's helped add some, dare I say, stability to the energy markets. You haven't seen oil completely roll over to the degree that you've seen the rest of the commodity complex. I think it just injects another element of uncertainty into this market. You have uncertainty coming from a lot of trades unwinding. You're heading into a very busy election season in the US. And now you have rising tensions in the Middle East. I think all of that just makes this recipe for more volatility, at least in the short term. But I don't think that I think is an aside. It's more related to just the energy complex. And I don't think that is what's causing, or at least it's very marginal to impacting the overall red we're seeing across the rest of the equity complex.
Right. If I circle back to your point that you made, whenever interest rates are cut, so when will that cut come? The Fed chair was not really very clear whether it will come in September or November. We really don't know. But will the current, if I may call, crisis in the markets force the Fed to call for an emergency meeting and announce a cut?
There's been some talk of that, but I think that would send a really dangerous signal, because the Fed is having an emergency meeting. Things really must be worse than we think if that's actually going to happen. I think September, my base case before a lot of this data was December. I've pulled that forward. I do think we're going to see a cut in September. I don't think we're going to see a 50 basis point cut unless there's really sharp deterioration over the next couple of data prints we're going to get. In advance of that, I think Powell set the table during the FOMC last week to have a cut in September, as long as the data cooperates. I think the data is cooperating with him on that front. But to get a 50 basis point cut, to get an emergency cut in front of that, that's going to require a massive revision to their summer of economic projections. It's going to really, I think it would send a very, very negative signal as to the reasons of why we're cutting. And I think, again, that's why I would argue, I think the market's gotten ahead of itself in pricing 100 basis points of cuts before the end of this year and a full 300 before the midpoint of next year. That's extreme, and I just don't see the hard or soft data points saying that things are that bad in the economy that we need to have that happen. You look at earnings, you look at what companies are telling us real time with respect to their results. We're getting double-digit year-over-year earnings growth. We're seeing a broadening of that growth across sectors. And guidance has been pretty good across the board, even in cyclical parts of this economy. So that gives me a little bit more solace that the foundation, the fundamental foundation, still remains in place.
So, Matt, you think, of course, there's a lot of overreaction at play over here. Any final thoughts?
So I would tell investors, when we start to get a little bit of stability, start to look at some of the mega caps, because again, I would argue they are in fact defensive given their earnings stories. Look at some of the higher quality cyclicals like industrials that are levered to AI CapEx spending. Those areas we continue to see increase from the hyperscalers. There's tons of opportunity across this market, and investors should use this pullback to build a balanced portfolio going forward.
All right, Matt Orton, appreciate your joining us on the broadcast this evening. Thank you.
Thank you. Good to see you.
Thank you.
All right, and so on that note, we slip into a very short break. But on the other side, we'll look at how Indian markets have reacted through the day and also get some advice in terms of what Indian investors should do next. Do stay with us. Welcome back. You're watching Profit 360, and our focus this evening is on the global sell-off, which we now see perhaps more sharp in the US, as they also seem to have taken those cues. Now, let's quickly bring your attention to what happened in the Indian markets. Now, the Nifty fell 400 points at opening bell, while the Sensex opened over 1,000 points in the red. The Nifty and the Sensex closed the day's trade about 2.5% down each. Now, the PSU pack of RVNL, Cochin Shipyard and Mazgon Dock bled heavily in trade today, down over 8%. FMCG stocks turned saviors for the Nifty, as Hindustan Unilever, Nestle, Britannia and Tata Consumer were the gainers in the Nifty, pulling the index back above 24,100 levels in late trade. Tata Motors, also one of the big losers in trade today, and the Nifty Metal Index was the top sectoral loser. And to discuss what's happened in the Indian markets, we've got Ajay Bagga joining us. Good evening, Mr. Bagga. Thank you very much for speaking to us on NDTV Profit. To begin with, what's your sense of what happened today? The Indian markets in the red, just like me, of course, but not looking too good today.
Yeah, but relatively much better than the rest of the world. And again, you know, what has fundamentally changed from last Wednesday, before the Bank of Japan came in with the rate hike, there was already carry trade unwinding happening, as we have seen with the Mexican peso, the Aussie getting hit already in the last 2 weeks. The big issues for the markets are concentrated returns from the Magnificent Seven, too much hype around AI, which is now leading to disappointment. Third, at all-time high levels, at elevated valuations, the room to stumble is just not there. So any little bit of disappointment is leading to sharp falls. And fourth, then today, Japan, US economy, Japanese carry trade unwinding, the geopolitical risk, and Warren Buffett selling a big chunk in a Magnificent Seven. I think all that came in together to spoil sentiment. Are we near to a domino effect in the markets? No. Is it like a 2000 euphoria and a bubble? No. The AI might have been a bubble. Yes, definitely. And those will suffer, like railways and defense stocks in India, all the 100 PE stocks in India. All those will get hit. But have the fundamentals changed? No. So I would say we'll have to refocus investors back to the fundamentals. This price has to be paid in the market, price-wise, time-wise. It always happens in market cycles. So we'll have to pay that price. But it's not. It's a time to prepare, not a time to panic. I think that's very clear.
Right. Ajay, Murli here. You have answered a number of questions I had in mind. You have very clearly said that this is not going to be a contagion. It will soon come back on track. Now, the question is, we should, from the investor's point of view, not traders, you're saying we should refocus on fundamentals and try and look at select stocks or sectors where you can find opportunity. In your view, what should investors do? Which kind of sectors should they wait and watch and pick up? Or should they simply go and pick up indices in the form of passive index funds?
Yeah, Murli, great to be on your show after a long time. I would say, I'm a very boring person for investors. I myself bought the entire market today. So I bought small cap indices, I bought mid cap indices, I bought the total market index. I found it on sale today, and I'll do that again tomorrow. But that's not what investors largely want to listen. But that boring strategy of get rich slowly is what makes money. So what I would say, picking stocks right now, yes, active fund managers can do it. For 99.99% investors, not very possible. One big question people are asking today, if Warren Buffett is sitting on $277 billion of cash, should we cash out of our portfolios? Yes, possible, but we will come to know his actions only on his declarations at the end of the quarter. So we don't know today if he has invested back in something or he's bailing out some company with all that cash. We'll never come to know unless, it's a big thing like in 2008 when he bailed out AIG and Goldman Sachs. So we can't really follow a big investor like that. We have to see what works for us. What works for us is being as diversified as possible. If you can pick up quality stocks and sectors, go for it. I don't, agree with the mutual fund industry, Murali, which has been launching manufacturing funds, defense funds, power funds. This is back to you. You are a veteran. You remember 2006, 7, 8 when infra funds were being launched by everybody, and it took 10 years to show any returns for those funds. So same we are doing with these manufacturing funds and blah blah funds. In June, mutual funds saw 22,000 crores coming into thematic and sectoral funds. While the best trade, if I could have shorted defense, I would have, most of them are cash stocks. So I just sold them off. And I've been saying that very publicly for the last 1.5 months, that you are factoring in the execution for the last 5, 6, 7 years with no room to stumble. That's not a very good scenario to make money. So I would say very concisely, stay invested, regularly invest, if possible, own the entire market, because on your own, finding out the sectors which will rotate and take these markets higher will be difficult. Fourth, the biggest risk is not being invested. Biggest risk right now is not having any skin in the game. So it's not that your portfolio is falling. That's the biggest risk. The biggest risk is not being a participant in the markets, because when these markets turn, they will turn so fast that in 2 weeks, the entire year's returns will come. So that's why I'm saying go and participate in the market, ignore this noise. How much further, how much longer, that nobody can really say that how much further these markets will fall, how much longer, because now it's in the grip of sentiments. But we know about $30 billion of margins were outstanding for retailers in the Japanese markets. That will take 3 to 4 days to work out. Hopefully, you will get some bottom formation around that time, unless some new crisis comes. Iran shoots some missiles tomorrow on Israel.
Correct.
There'll be a blip, and we can't really, invest for that. The only way to beat that is increasing your holding period. So, these risks are always there, Murali. The geopolitical risks, you can't.
True. Okay, so now I have some very interesting, suggestions and recommendations from you, Ajay. There were 4 points in the history of our markets and global markets: 1987, 1998, 2008, and now 2024. Now, you will be able to corroborate this one. Investors who have picked up and braved the market in a very disciplined manner during all these phases, I'm sure they would have made lots of money.
Yeah, absolutely. But, 2008 with, Merrill Lynch going down, with Lehman Brothers going down, Bear Stearns, it was a very difficult market to really pick up. And 21,000 Sensex in January 2008 went down to 8,000. And it took till 2013 to cross that 21,000. So it was a very difficult time for markets. Same for the NASDAQ at the dot-com bubble. If you remember, in February, Julian Robertson shut his fund. And, I used to sell his funds. I got that letter from him. He says, my cabbie in Manhattan was doing day trading during red lights. And I understood I can't make money in this market. He returned the funds in February. And March, the market started falling. It took a good 6 months to fall. And then for 10 years, NASDAQ didn't give returns. The Nikkei, 1989 didn't come back till early this year. So there are periods of markets we have seen when, at the Harshad Mania in 92, and that market in Sensex stayed below 3,000 till 2003. When you're old enough like me and you have seen all cycles, A, you are not afraid. Second, you laugh at yourself in trying to make any prediction. And then third, this too shall pass. This will pass and the fundamentals will win through. But right now, sentiments. So it's flows and sentiments.
True.
So people want, and with this program trading, think of a KOSPI, suspending program trading today.
Correct.
China did it 2 weeks back where 1,600 algos, they have taken all the algos and they have raised their fees to 10 times the normal fees to stop these program tradings doing what they did in 87. So I would say this too shall pass, but I don't know how much deeper and how much longer.
No, so let me, I think we have about 30 seconds tomorrow.
I'm sorry for the long
answer.
No,
it's okay. Now, we would love to have a longer chat, Ajay. But for tomorrow morning, when we wake up, should we look at Nifty at 23,000? Where will this stop? What is your reading?
See, there are 2 lakh crores of Japanese money, but in that 71 lakh crore, when I used to sell to Japanese investors, they would prefer Luxembourg. They didn't like Mauritius funds. They would like Ireland. So, Luxembourg and Ireland also have huge amounts sitting there out of that 71 lakh crores of FIs. That's the risk. And against that, mutual funds are sitting on about 1 lakh crores. And then the domestic money, the household money, which will come in. So how much of that Japanese money gets sold here to make up losses in the local market? That's the big question. When 24% is the cut, and it was a highly margined market, Murali, they brought in a tax-free product where households could take positions in the market on a tax-free basis in a margin product. So that is unraveling now, and that is causing all this issue across the globe, along with the AI issue in the US market. There is no slowdown in the US. Tomorrow, I'm hoping to write a blog, but today I've been on some 15 interviews with institutional investors asking the same questions. But I've got data. Your second quarter GDP in the US, you look at it, 2.8. Atlanta Fed GDP now running at 2.5. This level, as you said earlier, this is not a slowdown in jobs at 114,000. Yes, relatively, yes, you're getting lesser jobs. But April, the revised number was 108,000.
Right.
None of us saw it because it came 2 months later in revision.
Right.
So it's not a bad macro. It is bad sentiment by the Japanese retail products, which is causing so limited contagion to that extent.
Right.
AI disappointment at all-time high markets. This will pass very soon. I see it as shallow, but I'm always wrong, so I don't open my mouth.
So, okay, since you have spoken to so many institutions, I think we would love to connect with you again tomorrow to calm the nerves, and hopefully it should. Ajay, thank you so much for joining us and giving us all your insights and expert.
My pleasure. Thank you.
All right. In fact, on that note, we are completely out of time. So as Mr. Bagga said, stay invested. The biggest mistake will be not to participate. Thank you very much for joining us this evening.